Let's talk about the Nigeria Securities and Exchange Commission, which has rolled out the implementation of the new custodial arrangement for collective investment schemes or Euro or what you call managed funds in Nigeria. That came out within the last 24 hours. The head of the SEC said this is the implementation phase. The rule has been existing. Now it's been enforced for those who are dealing with managed funds within the Nigeria space. Let me talk to Johnson Chukwu, who is a licensed trader and CEO at Cowry Asset Management. He joins me now for this conversation with the latest move by the SEC. Good evening. Thanks for coming through on the show, Johnson.
Good evening, boss, and thank you for having me.
We appreciate your time. Sorry, the Eurobond is taking everyone's attention. I'm sure those of you in the markets are keeping your ears to the ground as to how this offer goes. But let's talk about the SEC custodial rule for managed funds or collective investment scheme. What is it all about? This new implementation, which the SEC has been existing, but now wants to enforce it.
Well, good thing like the SEC DG said, it's been in existence for quite some time. And the rule says that all assets managed by a fund manager, all assets under a collective investment scheme managed by a fund manager must be with a custodian. And basic thing that happens that the fund manager is basically to manage the funds, make the investments on behalf of the unit holders. The custodian is to hold the custody of those assets so that the fund manager does not have access to those assets without the authorization of without being released by the custodian. The custodians are the ones who distribute the assets or distribute the returns due to unit holders. So it has always been the practice. If you have to set up a fund, you must appoint a custodian. You must appoint a registrar who will keep records of the individual unit holders. The custodian will keep custody of the physical assets and cash, while the fund manager's job is to make the investments on behalf of the unit holders.
Okay,
so it has always been there. What SEC is saying that they want to ensure that it's enforced, is properly enforced.
What's the extant practice before what the SEC now wants to enforce and what all fund managers to implement?
I think what the SEC will want to enforce now is that when there is diminution in the value of the assets under management below the net, then it is the duty of the fund manager to ensure that that diminution is brought to the knowledge of the investors. Basic thing is that when you invest in a mutual fund, the value of the assets could actually go up or come down. It's expected that you manage the assets to go up. And maybe previously there may have been instances where the rules were not adhered to, where the fund manager or the asset manager allowed or had access to the assets or had access to the underlying assets of the fund, which shouldn't be the case because that's an aberration. It's a misnomer for the fund manager to have access to the underlying asset that should be with a custodian. So maybe there have been instances of that, which is what the SEC is saying, look, the rule has been there, but henceforth, we're going to make sure the rule is enforced to the letters. I can't imagine a situation where a custodian will allow the asset manager to transfer the asset outside their custody, unless if the asset is in either to sell the assets, where the process will come back to the custodian or the distribution of those assets.
Okay, so how large is the managed funds market in Nigeria? It looks like something the SEC has been talking about more in recent times. Saying, look, you don't need to get into the market. You need to use collective investment scheme, which is the term used in the Investment and Securities Act to describe any form of funds that is managed. Now, we've seen an increase in managed funds in Nigeria. Really, what do you think is the attraction?
Well, the attraction is that investors are able to spread their risk across same category of assets or across a broad spectrum of assets. If you invest in a mutual fund or collective investment scheme, what you have done in effect is that you have invested in several units of several fractions of units of different assets within that asset category that the fund is investing in. For instance, if you invest in a fixed income instrument, mutual fund or collective investment scheme, you have invested in the bonds, maybe federal government bonds, corporate bonds, Euro bonds, depending on what is the spectrum of assets that fund is invested in. So you're not just investing in one instrument. It also means that you have the benefit. If something goes wrong with one of the particular assets you have the fund, it's not going to be as severe as if you have invested in a single asset class or in a single asset. So the beauty of a collective investment scheme is that an investor is able to spread its investment across a broad asset classes so that your risk of losses are moderated because of the diversification.
So now that the SEC is asking collective investment schemes operators or managed funds, asset managers to ring fence what they call the custodian, in the manner of speaking, what would that mean for investors? Is it likely that the fees will go up or the cost of running this will go up for investors?
Not necessarily. It doesn't affect the fees. Rather, what we're pushing is that the cost of managing such funds keep reducing, because as the size of the funds is, cost will you spread the cost of managing the funds across a large size of collective investment instruments, then you are going to have a lower cost. For the investors, this gives them additional assurance that the assets are not at the reach of the fund managers, that the assets are held by a different entity who has no power to trade on those assets, who has no power to lend those assets, who has no power to use those assets. So if anything happens to the fund manager, the investors can actually still access their funds. All that happen that SEC will ask the custodian to transfer those assets to another fund manager who can now manage those things and pay returns to the investors or distribute the assets to the investors in that fund. So your risk is not tied. You don't suffer the key man risk of you're invested through a fund manager and the fund manager goes bust or something happens, then you would have lost your investment because your investment actually are held by the custodian. So it gives a further assurance to the investment that when you invest in a mutual fund, the collective investment scheme, your assets are separately held by custodian, not the fund manager or the asset manager. Well, and the likelihood that you will lose your assets is very low.
Okay. We appreciate your insights, as always, on the show. Thank you so much, Johnson Chukwu, CEO at Cowry Asset Management. Have a great evening.